After a volatile 2025, Applied Materials has recently surged 36%, climbing from $123 in April to nearly $195. Advanced packaging revenue hit $1.7 billion, and with AI chip demand booming, it's expected to double this year. And the company just hiked its dividend by 15% and greenlit a $10 billion buyback. But challenges still remain. US export controls have slashed Applied Materials' important China sales, and the macro environment looks pretty dark. In this video, we'll do an in-depth analysis of Applied Materials' business model, along with a deep dive into the current macroeconomics that might affect the company. Also, important news and developments, and if the smart money, including insiders, hedge funds, and super investors, are buying or selling. Applied Materials is a global leader in materials engineering, providing the equipment and software used to manufacture semiconductor chips and advanced displays. They built the tools that chipmakers like TSMC and Intel and Samsung use to build transistors and circuits on silicon wafers. Their specialty is manipulating materials at atomic levels, enabling critical steps like deposition, etching, and patterning. These processes are essential for building the dense, efficient chips that power everything from smartphones and AI to automotive and cloud infrastructure. The company is diversified across the semiconductor production value chain. They also support display fabrication, including OLED and LCD panels. Let's do a business model overview. First off, the value proposition is stellar. The company provides critical, highly specialized equipment used in semiconductor manufacturing, tools that are extremely difficult to replicate. This gives them a vital role in the chip production process. They're also positioned in a strong secular growth trend. As demand for chips increases in both volume and complexity, Applied Materials stands to benefit for years to come. Here is a graph showing the wafer fab equipment market expected growth. The market is projected to grow at 8% annually, reaching over $150 billion by 2031. That's a strong tailwind for Applied Materials, as they are a key player in this space. When it comes to optionality and pricing power, both are solid. Their wide product range and essential role in production gives them some flexibility and leverage with customers. Applied Materials is quite diversified and serves multiple interconnected markets like logic, memory, advanced displays, and emerging technologies like AI, which gives it some strategic flexibility. However, it operates in a competitive market, so pricing is still influenced by industry cycles and customer capex budgets. Their competitive advantage is also strong. It comes down to product quality, uniqueness, and specialization in niche markets, all of which are hard for competitors to match. So when you step back and look at the full picture, the overall quality of the business model is a thumbs up. I'd say a strong 3 out of 4. Management commentary for the latest quarter struck an overall optimistic tone. CEO Gary Dickerson stated that demand remains unchanged, even amid trade policy volatility, and emphasized that customers are continuing to invest in AI semiconductor products. CFO Bryce Hill echoed this sentiment, noting no significant shifts in customer demand and confidence in their ability to navigate market conditions. The company reported revenue of $7.1 billion, representing a 7% year-over-year increase, but this came in slightly below Wall Street estimates of $7.13 billion. Meanwhile, EPS guidance of $2.15 to $2.55 reflect an 11% growth outlook. Despite strong AI-driven demand, sales in China dropped sharply, falling from 43% of total revenues last year to just 25% this quarter. This decline raised some concerns among investors, contributing to a 5 to 6% drop in the stock price post-earnings. Still, management remains confident, with a revenue growth forecast of 6 to 7% and a firm stance that their long-term strategy is well aligned with the industry transition towards AI and advanced technologies. In March, Trump signed an executive order launching the US Investment Accelerator, which kind of rebrands the CHIPS Act created by Biden set up in 2022 to boost US chip manufacturing with over $50 billion in funding. While Applied Materials didn't receive direct funding, many of their customers, like Intel and TSMC, did. Since Applied Materials supplies the tools to build fabs, they stand to benefit as projects accelerate under the new office, which aims to cut red tape and streamline funding. Morningstar sees Applied Materials as the leading wafer fab equipment supplier, with a wide product range and strong cash generation. But it also notes that Applied is a generalist, competing with highly focused rivals like Lam Research and KLA, which hold advantages in certain niche areas. One of the biggest risks is cyclicality. The chip industry is volatile, and Applied earnings tend to rise and fall sharply with demand. Morningstar also flags geopolitical risks. Trump has levied renewed tariffs and tighter export rules. These US export controls already limit what Applied can sell to China, a major customer and driver of growth. AlphaSpread highlights similar strengths, like Applied's leadership in deposition and etch and its exposure to AI-driven chip demand. But they also warn about rising R&D costs. Staying ahead in advanced chipmaking is expensive, and delays in adoption can hit margins. Finally, state-backed Chinese rivals are gaining ground, and while AI and global fab investment offer long-term tailwinds, Applied's competitive edge will be tested. Quick reminder, everything here is just my personal opinion, not financial advice. Always do your own research before investing. And if you find this kind of breakdown helpful, hit that like button and subscribe for more deep dives on high-quality stocks, including both new and old videos about Applied Materials and other AI stocks. Let's break down the current macro environment in the US, starting with the data. Inflation is at 2.7% and rising, driven in part by trade tariffs and supply constraints. Unemployment is steady at 4.2%, but if it rises while inflation stays high, stagflation could be a risk. The IMF's GDP forecast was revised down to 1.8%, and the Fed expects 1.4% by year end. Monetary policy is mildly contractionary, with interest rates holding steady at around 4.25 to 4.5%. In contrast, fiscal policy is expansionary, with the government still stimulating the economy, partly in response to slowing GDP growth and the monetary policy Trump sees as too cautious. Meanwhile, the Fear and Greed Index sits at 74, deep in the greed zone, suggesting investor sentiment might be a bit too optimistic. This chart shows the GDP to market cap ratio, also known as the Buffett Indicator, a classic measure of overall market valuation. As of March 31st, 2025, we're seeing at 1.8 standard deviations above the historical trend line. That's extremely elevated, right near levels we saw during the dot-com bubble. Historically, levels this high have preceded significant corrections. A return to the historical mean would imply a potential 44% market decline. This aligns with historical mean reversion behavior observed over multiple market cycles. That's not a forecast, but it does highlight just how far valuations have drifted from economic fundamentals. Bottom line, markets are priced for perfection, and that makes this environment high risk. On the flip side though, markets are reinforced by major US fiscal stimulus, what some are calling the Big Beautiful Bill, plus a wave of deregulation that's pro-growth. These could help offset some of the downside risks in the near term. Taking all of this together, slowing GDP, rising risks, yet overconfident sentiment, our macro analysis leans clearly negative. So my verdict, thumbs down. Now let's look at the industry and competitors. The semiconductor equipment industry sits within the information technology sector and is defined by several key traits. It requires massive R&D investments and benefits from high barriers to entry. Innovation moves quickly, driving constant evolution. Demand tends to be cyclical, driven by capex spending from foundries and memory producers. But growth in AI, data, and advanced packaging is creating structural demand drivers. Service and software revenue is also rising, now accounting for over 15% of the market, adding more stability to what used to be a very volatile business. The leading players have long innovation cycles and enjoy strong pricing power due to limited competition. While Chinese players are emerging, their capabilities remain limited, so the competitive landscape remains favorable for the current global leaders, such as Applied Materials. This is an oligopolistic market dominated by a handful of players, each with specialized roles. Applied Materials, for example, leads in deposition and etch, while ASML utterly dominates lithography, and KLA focus on process control, inspection, and metrology. Competitive pressure in this market is high, but Applied Materials holds significant competitive advantages, including a broad product portfolio that spans multiple key process steps. Applied Materials holds about 20% of the market, with solid 5-year growth, 72% in revenue, and 138% in earnings per share. KLA Corp has been growing faster overall, gaining market share and posting the highest EPS growth at 234%, though it's still smaller in size. ASML is technically in the same space, but operates in a unique extreme ultraviolet lithography niche, so it's not a direct competitor. Meanwhile, Nikon shows very weak performance, with just 6% revenue growth, indicating it's falling behind significantly, losing relevance in lithography once its core strength. The overall picture, it's a concentrated market with leaders pulling further ahead. Over the last 5 years, Applied Materials has delivered a 221% return, outperforming most peers. KLA, however, has done even better, with over 360% growth, reflecting its increasing market share. Okay, let's look at where the so-called smart money is going when it comes to Applied Materials. One of the most important observations here is that both hedge funds and insiders are net sellers. Over the last quarter, hedge funds decreased their holdings by about 1.9 million shares. That's a pretty meaningful drop, especially considering that hedge funds tend to act on high conviction ideas. Over the past 12 months, insiders, so people who know the company best, sold over 197,000 shares while buying around 455,000. This is good, but in the last 3 months they haven't bought a single share and sold nearly 3,000. In the short term, they don't seem overly optimistic. Ownership overall is led by ETFs, institutions, and mutual funds, not insiders and hedge funds. When we zoom out over the last decade, the insider activity shows a clear trend, much more selling than buying. Now, it is worth noting that insiders often receive stock through compensation packages, so some selling of these is normal. But over the long term, consistent selling, especially without much buying, doesn't inspire confidence for long-term holders. Despite the selling from insiders and hedge funds, institutional ownership tells a more stable story. Nearly 3,500 institutions currently own shares in Applied, and this has held steady since about 2021. That kind of stability from large players can add a layer of confidence. But when we look at the super investors, the big names tracked on platforms like Dataroma, the picture is quite different. Applied ranks just 142 among super investor holdings. No one has a major position here relative to their total portfolio. Chris Davis holds the most at just about 4% of his portfolio, increasing slightly these past 6 months, but even that was only a modest increase during the recent dip. Chase Coleman holding is below 1%. Conclusion: hedge funds and insiders are selling, super investor ownership is low, and only institutional support remains firm. So overall smart money sentiment, just okay, maybe a weak meh. Wall Street recommendations. Analyst remains broadly bullish. Most firms rate it a moderate buy to a strong buy, with around 30 analysts giving buy or strong buy ratings and only a few holds with no sell recommendations. In summary, Wall Street thinks it's a buy, but expectations for near-term growth are modest. We'll talk in an upcoming video about their price targets and wherever I agree on those. If you want to go deeper into Applied Materials, make sure to check out the next 2 parts. In part 2, we break down the financials, revenue, margins, balance sheet, and more. Then in part 3, we run a full valuation, including DCF modeling and price targets. Hit subscribe so you don't miss either one.